In 1929, Joseph Kennedy sold his stock positions and walked away with his fortune intact while the market collapsed 89%. In 1987, Paul Tudor Jones made $100 million in a single day when the Dow fell 22.6%. In 2008, Michael Burry and John Paulson made billions shorting the housing market while banks imploded. And right now, in 2025, Warren Buffett is sitting on $348 billion in cash, the largest corporate cash position in American history. These aren't isolated events, there's a pattern here. Before every major crash in the last century, the smartest investors make the same 3 trades. Not 2, not 5. 3. The same 3 moves executed in the same sequence that protect wealth and generate massive profits when markets collapse. Let me show you exactly what these 3 trades are, how they worked in 1929, 1987, and 2008, and why they're happening right now in 2025. Because if you understand this pattern, you have a choice. You can ignore it like most people do and watch your portfolio drop 30 to 50% or more, or you can recognize where we are in the cycle and position accordingly. The pattern is repeating. The 3 trades are active. Let's break down exactly what they are. The first trade happens 12 to 18 months before the crash. It's the earliest signal. Smart money recognizes that valuations have reached unsustainable levels, and they systematically exit their positions. This isn't panic selling, it's methodical, calculated conversion to cash. Let's start with 1929. Joseph Kennedy was one of the most aggressive stock speculators of the Roaring Twenties. He'd made millions manipulating stock prices through coordinated buying schemes that were perfectly legal at the time. By early 1929, Kennedy controlled substantial positions across multiple stocks. The market had tripled in 5 years. Everyone was buying on margin, borrowing 90% to buy more shares. It was pure euphoria. But Kennedy understood something critical. When everyone is fully invested and leveraged to the hilt, there's nobody left to buy, and without new buyers, prices fall. When prices fall even slightly, leveraged investors face margin calls and are forced to sell. That selling drives prices lower, triggering more margin calls, creating a death spiral. In the summer of 1929, Kennedy began converting his positions to cash. Not all at once, because that would move the market against him, but steadily over several months. By September, he was substantially liquid. The Dow peaked on September 3rd at 381. The crash began October 24th, 7 weeks later. Kennedy sat in cash, protected, while everyone else lost everything. Fast forward to 1987. Paul Tudor Jones ran a successful hedge fund, but by mid-1987 he was deeply concerned. The Dow had risen from under 1,000 in 1982 to over 2,400 by August 1987, a 140% gain in 5 years. Price-to-earnings ratios were stretched, margin debt was surging, and a new phenomenon called program trading, where computers executed massive trades automatically, was creating dangerous instability. Jones studied the 1929 crash obsessively. He and his analyst Peter Borish mapped the 1987 market movements against 1929 and found eerie similarities. Jones concluded a crash was coming within months. Throughout August and early September, he systematically reduced his long positions and raised cash. He wrote memos to investors predicting a crash by October. This wasn't speculation, he was specific. The market peaked October 2nd at 2,722. The crash came October 19th, 17 days later. By then, Jones was substantially in cash and positioned for what came next. Now, 2008. Multiple investors recognized the housing bubble at different times. Michael Burry started in 2005. His analysis of mortgage lending practices convinced him the system would collapse. He stopped buying stocks and raised cash while preparing his contrarian bet. John Paulson reached the same conclusion in 2006 and launched a fund specifically to bet against housing. Warren Buffett had been raising cash since 2006. Berkshire Hathaway's cash position grew from $40 billion in 2006 to over $60 billion by 2007. When asked why, Buffett simply said he couldn't find anything worth buying at current prices. Translation: everything is overvalued. The market peaked in October 2007. By then, Burry, Paulson, Buffett, and others were holding massive cash positions. They were protected when the collapse accelerated through 2008. Which brings us to 2025. Warren Buffett's Berkshire Hathaway is sitting on $348 billion in cash and short-term treasury bills. Let me repeat that, $348 billion, the largest cash position in corporate history. Buffett has been systematically selling stocks to raise this cash. He sold over 600 million shares of Apple in 2024, reducing his stake by 67%. He sold 41% of Bank of America. He's not buying anything, but it's not just Buffett. Jeff Bezos sold over $13 billion in Amazon stock in 2024 and early 2025. Mark Zuckerberg sold billions in Meta shares at all-time highs. Jamie Dimon, CEO of JP Morgan Chase, sold company stock for the first time ever in his tenure. Insider selling across corporate America is at levels not seen since 2007. These are the people who see the real financials, the real customer data, the real problems. And they're converting to cash. Trade 1 is happening right now. The smart money is out. The second trade happens during the same 12 to 24 month window as trade 1. While sitting in cash, you're exposed to currency devaluation and inflation. Gold is the hedge. It's been the solution for 5,000 years and it works every single time. In 1929, Bernard Baruch was one of the most successful investors of the early 20th century. He'd made fortunes recognizing bubbles before they burst. When Baruch exited the stock market in 1929, he didn't just hold cash, he converted substantial positions to physical gold. He understood that the crash would lead to deflation initially, but then governments would manipulate currencies and inflate. Gold was fixed at $20.67 per ounce at the time. It maintained that value through the crash. But in 1934, when President Roosevelt revalued gold to $35 per ounce, anyone holding gold saw a 69% gain in dollar terms. Baruch's gold holdings appreciated massively, while stocks continued falling. By the mid-1930s, he was wealthier than before the crash. In 1987, gold's role was different because the crash recovered quickly. But investors who bought gold in 1986 and early 1987 still profited. Gold was around $300 per ounce in early 1987. During the October crash, it spiked to $475 as investors fled to safety, a 58% gain. Paul Tudor Jones held gold positions alongside his cash as part of his defensive strategy. 2008 is where trade 2 became critically important. Gold was around $600 per ounce in 2007 when smart money started positioning. As the financial crisis unfolded, as banks failed and the Federal Reserve started printing money, gold surged. By March 2008, it hit $1,000. By 2009, over $1,200, it eventually peaked at $1,900 in 2011. John Paulson, after making billions shorting mortgages, deployed massive capital into gold. He understood the Fed's response would be unlimited money printing. And money printing means currency devaluation. His gold fund made billions on top of his mortgage short gains. Now 2025. This is where trade 2 becomes absolutely critical. Central banks globally have been buying gold at record rates. In 2022, 2023, and 2024, central banks purchased over 3,000 tons of gold, the highest 3-year total since records began in 1950. China has been buying, Russia has been buying, India, Turkey, Poland, Singapore, all accumulating. They're diversifying away from dollars because they see unsustainable US debt and inevitable currency devaluation. And it's not just central banks. Ray Dalio has been vocal about holding 5 to 10% of portfolios in gold. Stanley Druckenmiller has disclosed significant gold positions. Paul Tudor Jones himself has said publicly he owns gold as a hedge. Gold is currently trading around $4,100 to $4,200 per ounce. Record highs. Why? Because smart money is executing trade 2 right now. They've converted to cash in trade 1. Now they're converting portions of that cash to gold for wealth preservation. When the crash comes, when the Fed responds with massive money printing, gold will surge to 5,000, 6,000, potentially higher. The investors holding gold will preserve purchasing power while everyone else holding dollars gets destroyed. Trade 2 is active. Gold accumulation is happening at unprecedented scale. The third trade is the profit trade. Trade 1 protects you. Trade 2 preserves wealth. Trade 3 makes you rich. This happened 6 to 12 months before the crash, and it requires instruments that pay when markets collapse. In 1929, after Kennedy exited to cash, he established short positions in multiple stocks. Shorting means borrowing shares, selling them at current prices, hoping to buy them back cheaper later. Kennedy paid borrowing costs while stocks continued rising through September, but he understood the math. When the crash came in October, stocks fell 30% in days, 50% within weeks. Kennedy covered his shorts by buying back shares at collapsed prices. The profit estimates suggest he made $15 to $50 million, equivalent to hundreds of millions today. 1987 is legendary. Paul Tudor Jones's trade spree was captured on film. After raising cash and buying gold, Jones bought massive positions in put options on stock index futures. Put options give you the right to sell at a predetermined price. If the market crashes below your strike price, your puts explode in value. Jones bought thousands of contracts and spent millions in premiums. On October 19, 1987, the Dow fell 508 points, 22.6%, the largest single-day percentage decline in history. Jones's put options exploded in value. He made $100 million that day. His fund was up 62% in October alone. A documentary crew happened to be filming him, capturing him on the phone executing trades, making millions in real time. It's the most perfect execution of trade free ever recorded. 2008 is now famous from the book and movie The Big Short. Michael Burry couldn't short subprime mortgages directly because the instruments didn't exist. So he worked with banks to create credit default swaps on mortgage bonds. These are insurance contracts. Burry paid premiums, roughly 2 to 4% per year on the insured amount. If the bonds didn't default, he lost the premium. If they defaulted, he collected the full insured amount. From 2005 through 2007, Burry paid these premiums while his investors revolted. They thought he'd lost his mind. The housing market kept rising. But in 2007, defaults started spiking. By early 2008, the bonds Burry had insured began collapsing. The credit default swaps paid out. Contracts he bought for a few million paid out hundreds of millions. His fund made over $700 million for investors. He personally made $100 million. John Paulson executed the same trade on a larger scale. His funds bought tens of billions in credit default swaps. When the housing market collapsed, Paulson collected $15 billion in payouts. He personally made $4 billion. It's been called the greatest trade ever. Trade 3 is happening right now. The instruments are credit default swaps on commercial real estate, put options on stocks and indices, and VIX call options. Credit default swaps on commercial real estate have spiked 300 to 500% in price since 2021. Why? Because sophisticated investors believe commercial real estate will collapse. Office buildings sit 40 to 50% vacant due to permanent remote work. Mortgages that were financed at 3% now need refinancing at 8%. The math doesn't work. Defaults are coming. Put options on major indices have seen unusual institutional activity. Large purchases of puts expiring in late 2025 and 2026. These are bets that markets will crash during that window. The put-call ratio has been elevated, indicating institutions are buying protection. VIX call options are another signal. The VIX measures market volatility and spikes during crashes. Buying VIX calls is betting volatility will explode. Bill Ackman has discussed publicly that he's considering similar hedges to his March 2020 trade when he turned 27 million into 2.6 billion in weeks. The pattern is undeniable. Across 1929, 1987, 2008, and now 2025, the same 3 trades happen in sequence. Convert to cash 12 to 18 months before. Accumulate gold for wealth preservation. Buy volatility instruments that explode when markets crash. These aren't random strategies, they're mechanical responses to the same setup every single time. Every major crash follows the same sequence. It starts with extreme valuations. Asset prices disconnect from fundamentals. In 1929, stocks traded at absurd multiples. In 1987, the Dow had more than doubled in 5 years. In 2008, housing prices doubled based on fraudulent lending. In 2025, the Buffett indicator is at 185%. Stocks are valued at almost twice GDP. Then comes euphoria. Everyone believes prices will keep rising forever. In 1929, shoeshine boys gave stock tips. In 2008, everyone believed housing never falls. In 2025, artificial intelligence is the narrative justifying any valuation. Next is maximum leverage. When prices rise, everyone borrows to buy more. In 1929, 90% margin debt. In 2008, 50 to 1 leverage in the financial system. In 2025, margin debt is near record highs. Then a trigger event causes a small decline. The specific trigger doesn't matter. What matters is stage 5, forced liquidation. When leveraged investors face losses, they get margin calls and are forced to sell. That selling drives prices lower, triggering more margin calls. It's a death spiral. Finally, panic. Fear takes over, liquidity disappears, the VIX spikes to 50, 60, 70. Markets fall 20, 30, 40% in weeks. This is when the free trades pay off. Cash means you're not being liquidated. Gold means you're not holding depreciating currency. Volatility bets mean you're profiting from the crash itself. We're in late stage positioning. Trade 1 is substantially complete. Buffett's $348 billion. Insider selling at 2007 levels. The smart money is out. Trade 2 is accelerating. Central banks buying 3,000 tons of gold over 3 years. Gold at record highs above 4,100. The wealth preservation trade is happening. Trade 3 is being established. Credit default swaps on commercial real estate spiking. Put options being purchased by institutions. VIX call activity. The volatility bets are being placed. Based on the historical pattern, the crash arrives in the next 12 to 18 months, late 2025 or into 2026. Could be sooner if a trigger accelerates the timeline, could be slightly later if markets stay irrational longer. But the window is clear. When it comes, when commercial real estate collapses, when regional banks fail, when unemployment spikes, the free trades will pay off exactly like they did in 1929, 1987, and 2008. Most people can't execute these trades at institutional scale, but understanding the pattern gives you enormous advantage. You can execute simplified versions. Trade 1, raise cash. If you're 70% invested in stocks, reduce to 40 or 50%. Hold the difference in cash or short-term treasury bills. Yes, you might miss some gains if markets keep rising, but when the crash comes, you'll have capital protected and ready to deploy at the bottom. Trade 2, buy gold. 5 to 10% of your portfolio in physical gold or gold ETFs, not mining stocks, physical gold. When the crash comes and the Fed prints unlimited money, gold will surge. This preserves purchasing power. Trade 3, buy protection. You can buy put options on SPY, the S&P 500 ETF. Buy puts expiring in 6 to 12 months with strike prices 10 to 20% below current levels. You'll pay 1 to 3% of portfolio value. If markets crash, those puts could return 5 to 10 times what you paid. If markets don't crash, you lose the premium. But that's insurance. The most important thing is psychological preparation. When the crash comes, when markets are down 40 to 50%, when unemployment is spiking and banks are failing, you need to be ready to buy. Have a list of quality companies you want to own. Companies with strong balance sheets, low debt, products people always need. Apple, Microsoft, Visa, Johnson & Johnson, Procter & Gamble. When these companies are on sale at 50% off, you buy with the cash you protected, with the purchasing power you preserved in gold, with the profits you made on volatility. You buy aggressively when everyone else is paralyzed by fear. This is the hardest part. Not the execution of the free trades, but having the courage to act when it feels like the world is ending. Kennedy had it, Baruch had it, Tudor Jones had it, Burry, Paulson, Buffett, they all had it. The willingness to buy at maximum fear. The free trades aren't secret. They're not insider information. They're documented historical pattern that repeats because crashes follow the same mechanical sequence. Extreme valuations, excessive leverage, a trigger, forced liquidation, panic. And the investors who see it coming make free trades, convert to cash, buy gold, bet on volatility. These trades worked in 1929, they worked in 1987, they worked in 2008, and they're being executed right now in 2025 by the smartest investors in the world. Warren Buffett sitting on $348 billion in cash. That's trade 1. Central banks buying 3,000 tons of gold. That's trade 2. Hedge funds buying credit default swaps and put options. That's trade 3. The pattern is playing out in real time. The only question is whether you'll recognize it and position accordingly, or whether you'll ignore it and hold through the crash, losing 30 to 50% or more. Most people will ignore it. They always do. They'll believe this time is different. They'll believe AI changes everything. They'll believe valuations don't matter. And they'll lose everything, just like most people did in 1929, 1987, and 2008. But a small group will see the pattern. They'll execute simplified versions of the three trades. They'll protect capital, preserve wealth, and profit from the crash. And then they'll buy at the bottom and become wealthier than they imagined. The choice is yours. The three trades have been made. The pattern is repeating. The crash is coming. If this video showed you a pattern you'd never seen before, subscribe to this channel. Over the next 12 to 18 months, I'll track every signal, every insider sale, every gold purchase by central banks, every spike in credit default swap prices, every warning sign that the crash is approaching. You'll see the pattern unfold in real time and you'll know exactly when to act. This is pattern recognition. The pattern has repeated 4 times in the last century: 1929, 1987, 2008, and now 2025. The three trades are the same, the sequence is the same, the outcome will be the same. Position yourself while you still can, because when the crash comes, when it's already happening, it's too late. The trades have to be made before the crash. That's the whole point.